Greetings, my fellow pilgrims on the winding road of economic understanding. As we traverse the ever-shifting landscape of monetary policy and financial markets, a peculiar phenomenon unfolds before our eyes. Central banks around the world seem to be engaged in an intricate dance, a choreographed routine of interest rate adjustments that resembles nothing so much as a global monetary merry-go-round. This week promises to be a pivotal moment in this ongoing performance, as a quartet of central banks from advanced economies take center stage. Each will make their pronouncements, their decisions reverberating through the interconnected web of international finance like pebbles tossed into a still pond. The question on everyone's mind is simple: will they cut rates or will they hold firm? Yet the implications of their choices extend far beyond mere numbers on a spreadsheet. These decisions have the power to shape the very trajectory of economic growth, to influence the ebb and flow of capital, and to impact the lives of billions across the globe. Let us begin our exploration with the Venerable Bank of England. This ancient institution, steeped in tradition yet tasked with navigating the modern complexities of Brexit and political upheaval, finds itself at a crossroads. On the one hand, the specter of slowing growth and the siren call of synchronized global easing beckon them to lower borrowing costs. Yet on the other, the looming specter of a general election and lingering inflationary pressures counsel a more cautious approach. Across the English Channel, the ever-inscrutable Swiss National Bank also faces a momentous choice. Having taken the bold step of easing monetary policy ahead of its neighbors back in March, the question now arises: will they double down on this dovish stance, or will they hold their fire, wary of fanning the flames of inflation and weakening the franc? Meanwhile, in the Antipodean realms of Australia and Norway, a similar refrain echoes. Policymakers in these distant lands seem disinclined to rush headlong into the rate-cutting frenzy that has gripped other nations. For now, at least, they appear content to watch and wait, their prudence born of a conviction that the economic fundamentals do not yet demand such drastic action. As this global monetary ballet unfolds, a discordant note arises from the verdant valleys of South America. While their northern counterparts contemplate easing, the central banks of Brazil and Paraguay seem poised to hold the line, steadfast in their commitment to controlling inflation and maintaining economic stability. And in Chile, a curious counterpoint emerges, as policymakers there are expected to slow the pace of rate cuts, a graduated approach that reflects the nuanced dynamics at play in their domestic economy. Amidst this swirling vortex of monetary maneuvers, a clarion call rings out from the hallowed halls of the Federal Reserve. In the wake of last week's modest downgrading of projected rate cuts, a phalanx of Fed officials take to the airwaves and podiums, their voices a chorus of perspectives that will undoubtedly shape market expectations and color the global financial discourse. Yet this is merely the overture, the opening movement in a symphony that will play out across the coming days and weeks. For as central banks deliberate and investors scrutinize their every utterance, a wealth of economic data will emerge, like so many instruments joining the orchestral swell. In the United States, retail sales figures, housing market indicators, and industrial production numbers will offer crucial insights into the vigor of the American consumer and the resilience of the nation's economic engine. Across the Pacific, China's monthly deluge of data will provide a window into the world's second-largest economy, its industrial might, and the spending habits of its vast populace. Elsewhere, inflation reports from the United Kingdom and Japan will command attention, their implications rippling through bond markets and currency trading floors. And in the sleepy islands of New Zealand, economic growth figures may herald a tentative emergence from the shadows of contraction. As this rich tapestry of data unfurls, a singular truth emerges: we live in an era of unprecedented interconnectedness, where the decisions of a handful of central bankers and the economic performance of a few key nations can catalyze shockwaves that reverberate across the globe. It is a delicate dance, this global monetary merry-go-round, a choreographed spectacle that requires exquisite timing and deft footwork from all involved. A misstep here, an ill-timed pivot there, and the entire routine threatens to unravel, sending markets into chaos and upending the fragile equilibrium upon which our economic fortunes rest. Yet therein lies the beauty and the thrill of this intricate performance. For in the midst of such complexity, such interwoven dynamics, we catch glimpses of the profound human ingenuity that has given rise to this global financial ecosystem. It is a testament to our species' capacity for cooperation and coordination on a grand scale, a feat of collective action that transcends borders and cultures. As we bear witness to these unfolding events, it behooves us to approach them with a sense of wonder and humility. For in the grand scheme of things, we are but spectators, observing the ebb and flow of forces far larger than any one individual or nation. And so, my friends, let us settle into our seats, our programs in hand, and prepare to be enthralled by the latest act in this ever-unfolding global monetary drama. Whether the central banks opt for restraint or embrace accommodation, their decisions will reverberate through the halls of finance and the corridors of power. And we, humble students of economics and keen observers of the human condition, will bear witness to it all, our minds expanded and our appreciation for the intricate tapestry of global finance deepened with every turn of this mesmerizing merry-go-round.